Welcome, my name is Nathan Weiskup, a junior at the University of Nebraska Omaha. To demonstrate key skills relevant for aspiring business banking professionals, I've created this video series exploring the fundamentals of commercial credit analysis. Commercial banking focuses specifically on providing financial services and solutions to businesses, ranging from small local companies to large corporations. The core function, as outlined here, is helping these businesses manage finances, fund operations, and achieve growth. This typically involves providing specialized products like lines of credit for working capital, term loans for equipment purchases or expansion, and treasury management services to optimize cash flow. Commercial banks play a vital role in the economy, especially at the local level, like here in Omaha. By providing essential capital and financial expertise, these banks empower local businesses to expand their operations, hire more employees, and ultimately contribute to the community's overall economic health. It's truly about partnering with these businesses to facilitate their success. With the commercial banking team, you typically have relationship managers, who are the primary client contact. They build relationships, understand client needs, and originate loan requests. Supporting the relationship managers are credit analysis. The analysis role is critical. They dive deep into the financial health of the business, using tools and techniques we'll discuss. They assess the risks associated with lending and prepare the detailed analysis that informs the final credit decision. This involves the financial statement analysis, ratio calculations, and research, which we'll cover later. The objective of this mini course is to walk through that fundamental analytical process. We'll cover interpreting financial statements, understanding key financial ratios and what they tell us. We'll explore credit risk frameworks like the 5 C's, recognizing the importance of industry context, and seeing how this analysis is typically presented within a bank. These skills directly relate to the core functions listed for the internship, such as assisting in analysis and supporting relationship managers. Let's get started with Module 2, Deconstructing Financial Statements. In this module, we'll look at 3 core financial statements that form the bedrock of credit analysis: the balance sheet, income statement, and cash flow statements. Familiarity with these is crucial for any business banking role. For our examples throughout this series, we'll refer to a simplified hypothetical company. Let's call it Omaha Manufacturing, Inc. We'll be looking at its financial data for the last 2 years to illustrate key concepts. First is the balance sheet. Think of it as a financial snapshot. It shows the company's assets, liabilities, and equity at a specific point in time. It always follows the fundamental accounting equation as you see here. Assets must equal liabilities plus equity. From a lender's perspective, we focus on some key areas. We analyze current assets like cash, accounts receivable, and inventory to gauge liquidity. On the other hand, current liabilities represent near-term obligations the company must meet. Long-term debt is crucial for understanding leverage, and equity, the owner's stake, shows their commitment and provides a cushion against potential losses. Next, the income statement, also called the profit and loss or P&L. Unlike the balance sheet snapshot, this financial statement shows financial performance over a period of time, like a quarter or a full year. Its main purpose is to show whether the company was profitable during that period. Key lines we analyze on the income statement include revenue. We want to see stable or growing trends. Operating expenses, like selling, general, and administrative expenses, show the overhead required to run the business. EBITDA is a very common metric used as a proxy for operating cash flow before financing costs and taxes. It's often used in loan covenants. And finally, net income is the bottom line profit after all costs are accounted for. The third key statement is the cash flow statement. This is critical because profit doesn't always equal cash in the bank due to non-cash items and working capital changes. This statement tracks the actual movements of cash, inflows and outflows, over the same period as the income statement. It's typically broken down into 3 main categories: operating, investing, and financing. Operating activities show cash generated from the main business. This is the most important section for lenders, as it indicates the company's ability to generate cash internally to sustain itself and service debt. Investing activities track cash used for long-term assets, like equipment. Financing activities show cash flows related to debt and equity, such as borrowing funds, repaying principal, or issuing stock. Bankers focus heavily on cash flow from operations to ensure that the core business is generating enough cash. Understanding how these 3 financial statements interlink provides a comprehensive view of a company's financial health, its position at a point in time, its performance over time, and its actual cash flow movements. In the next module, we'll use hypothetical data from Omaha Manufacturing, Inc. to calculate and interpret key financial ratios derived from these statements. Now that we understand the basic financial statements, let's move on to the ratio analysis. Ratios are powerful tools because they standardize numbers, allowing us to compare a company's performance over time, do trend analysis, and view those ratios in light of industry standards. They help us quickly assess specific areas of risk in financial health using data derived from the financial statements. First, let's look at liquidity ratios. Their purpose is to measure a company's ability to meet its short-term financial obligations. A primary liquidity measure is the current ratio. The formula is current assets divided by current liabilities. Using our hypothetical example, year 2 data for Omaha Manufacturing Inc., current assets of $1.8 million and current liabilities of $1 million, we calculate the current ratio to be 1.8x. So what does 1.8x mean? It signifies that Omaha Manufacturing has $1.80 of current assets available to cover every $1 of liabilities coming due within the year. A ratio like this is generally considered healthy, suggesting a good buffer. However, context matters. Very high ratios could sometimes indicate inefficient use of assets. The quick ratio provides a stricter liquidity view. As shown, its formula subtracts inventory from current assets before dividing by current liabilities, because inventory can be harder to convert to cash quickly. A ratio above 1x is generally preferred, suggesting the company can meet its immediate obligations even without relying on inventory sales. Next, let's discuss leverage ratios. These ratios help us understand how much debt a company uses to finance its assets, which is a key indicator of its financial risk. A fundamental leverage ratio is debt to equity. The formula compares total debt, both short-term and long-term, to total equity. For Omaha Manufacturing Inc., assuming total debt of $2.5 million and total equity of $2.5 million in year 2, the debt to equity ratio is 1x, or 100%. This 1x ratio means the company is financed equally by debt and equity. For every dollar of owner's capital, there's a dollar of creditor financing. A higher ratio signifies greater leverage and potentially higher financial risk. It's crucial to compare this ratio to industry averages, as acceptable levels vary widely. Now for a ratio that is absolutely critical for lenders, the debt service coverage ratio, or the DSCR. As the formula shows, a common calculation compares EBITDA as a proxy for cash available for debt service to the total required debt payments for the period, typically the current portion of long-term debt, plus interest expenses. Using our hypothetical numbers for Omaha Manufacturing Inc., the DSCR calculates to 1.75x. A DSCR of 1.75x is quite strong. It indicates that the company generated $1.75 in operating cash flow using EBITDA as our estimate for every $1 it needed to cover its scheduled principal and interest payments during the year. Banks often include minimum DSCR levels, frequently 1.2x or 1.25x or higher, in their loan agreements as covenants. Falling below 1x is a significant warning sign, meaning that the company didn't quite generate enough operational cash flow to meet its required debt payments. Finally, let's touch on profitability ratios. These measure how effectively a company generates profit from its sales and investments. Two key margins are gross profit margin and net profit margin. The gross profit margin, calculated here as 40% for Omaha Manufacturing Inc., shows how much profit is kept from revenue after accounting for direct costs. The net profit margin, calculated as 8%, shows the final bottom line profit after all expenses, interest, and taxes are deducted. Interpreting these, the 40% gross margin means 40 cents are left from each sales dollar after direct production costs, reflecting pricing power and efficiency. The 8% net margin reflects overall profitability, keeping 8 cents per sales dollar after everything. Analysts look at trends over time and compare them against industry benchmarks. Lastly, we'll look at return on equity, or ROE. This measures the return the company generates on the money invested by its owners, calculated as net income divided by the total equity. Omaha Manufacturing's ROE is 16%. This means it generates 16 cents of profit for every dollar of shareholders' equity. While higher is generally better, it needs to be assessed relative to the industry norms and the company's risk. Calculating and interpreting these ratios provides a crucial quantitative foundation for assessing a company's financial health. These ratios help identify trends, strengths, and weaknesses, but they don't tell the whole story on their own. We must consider them within the broader context of qualitative factors and overall risk, which leads us perfectly into our next module on credit risk assessment and using the 5 C's. Welcome to Module 4, an introduction to credit risk assessment and the 5 C's. In the previous modules, we focused on the what, analyzing the financial statements and the ratios using data from our hypothetical company, Omaha Manufacturing Inc. Now we shift focus to the why, understanding and assessing credit risk from the bank's perspective and using a common framework. Credit risk is fundamentally the risk that a borrower will fail to repay their loan as promised. For any bank, effectively managing the risk is absolutely essential for its own financial health. Assessing credit risk accurately involves looking beyond just the financial ratios we calculated. It requires understanding the underlying factors impacting repayment ability. It's often described as both a science and an art, the rigorous analysis and the experienced judgment involved. A widely used framework that helps structure this assessment is known as the 5 C's of credit. It provides a comprehensive checklist to evaluate both the borrower and the specifics of the loan request. The first C is character. This refers to the borrower's reputation, integrity, and crucially, their track record of meeting past financial obligations. Is management experienced and trustworthy? This is often assessed through things like credit reports, references, and the relationship manager's direct knowledge of the client. Second is capacity. This is arguably the most critical C. It represents the borrower's ability to generate enough cash flow to actually make the loan payments. This ties directly back to our analysis in Module 2 and 3. The cash flow statement, and particularly the ratios like the debt service coverage ratio, the DSCR, we calculated for Omaha Manufacturing Inc., are essential tools for assessing capacity. It involves looking at past performance and often projecting future cash generation. Third is capital. This refers to the borrower's net worth or financial cushion, essentially how much of their own money is invested in the business. We assess this when looking at the equity section of the balance sheet and calculating the debt to equity ratio. A strong capital base demonstrates owner commitment and provides a buffer to absorb potential losses, protecting the bank. Fourth is collateral. These are specific assets the borrower pledges to the bank to secure the loan. If the borrower unfortunately defaults, the bank has the legal right to seize and sell this collateral. Things like equipment, inventory, accounts receivable, or real estate may be sold to recoup its funds. Collateral acts like a secondary source of repayment and helps mitigate the bank's risk. The final C is conditions. This encompasses the purpose of the loan itself. What will the loan be used for? And very importantly, it includes external economic and industry conditions the business operates within. Are market conditions favorable? What are the industry trends? Assessing these conditions is vital and will be the focus of our next module. Crucially, no single C determines the loan decision by itself. Bankers evaluate all 5 factors, weighing their relative strengths and weaknesses to form a holistic view of the credit risk. Understanding this 5 C's framework provides essential context for our financial analysis and is fundamental to commercial lending. In Module 5, we'll dive deeper into looking at industry and market research. Welcome to Module 5, in which we'll discuss the importance of industry and market research. As we just covered, this directly informs the conditions aspect of the 5 C's framework and provides a crucial context for understanding a borrower's financial health and prospects. A company's success isn't solely determined by its internal operations. It's heavily influenced by the dynamics of its industry and the economic conditions of its market. For instance, a local restaurant's prospects differ greatly depending on local employment trends and consumer spending. Understanding these external factors helps bankers interpret financial performance correctly, assess the likely sustainability of cash flows, and identify potential risks that aren't immediately obvious from the financial statements alone. When supporting relationship managers or analyzing a credit, research often focuses on several key areas. We look at industry trends. Is the sector growing or shrinking? Are there technological changes impacting players? Understanding typical industry financial norms is also vital for comparison. We analyze the comparative landscape. Who are the main competitors? What is the borrower's position in the market? Crucially, especially for a role in Omaha business banking, we assess local market conditions. Are major local employers expanding or contracting? What are the demographic trends? Finally, we consider the regulatory environment. Are there any specific regulations that pose risks or opportunities? Analysts gather this information from various sources. Public data from government agencies like the Bureau of Labor Statistics or Census Bureau and the local resources like the Greater Omaha Chamber of Commerce website provide valuable economic and demographic context. Specialized industry reports from subscription services or trade associations offer deep dives. Keeping up with local and national business news is important, and of course, insights gained directly from the discussions with the client are also key. Conducting effective industry and market research provides that crucial context needed to truly understand a credit request. It helps relationship managers and analysts see the bigger picture beyond just the numbers. In the next module, we'll be looking at how to present these findings in the credit memo. In this module, we'll conceptually discuss how these findings are typically consolidated and formally communicated within the bank, often through a document called a credit memo, or a similar credit approval package. The credit memo serves as the central and formal document for a specific loan request. Its primary audience includes credit officers, senior management, or a loan committee, the individuals responsible for approving the credit. Its purpose is to present a concise yet comprehensive summary of all the analysis performed, clearly outline the strengths, the weaknesses, and risks associated with the borrower and the request, and critically, to make a well-supported recommendation on whether to approve, decline, or perhaps approve the loan with specific modifications. While the exact format varies between banks, a credit memo generally includes several key sections, logically flowing from the background to conclusion. You'll typically find borrower information detailing the company and its management. The loan request section outlines the specifics, how much, for what purpose, and under what proposed terms. The financial analysis summary presents the key findings from the statement review and ratio calculations we did conceptually in modules 2 and 3. An industry and market overview provides the external context from module 5's research. The risk assessment section explicitly discusses the 5 C's, highlights key risks, and notes any mitigating factors, drawing directly from module 4. Often there's a summary of the overall banking relationship, and finally, the crucial recommendation section, which must be clearly justified by the preceding analysis. Simply doing the analysis isn't enough. Communicating it effectively is critical. The credit memo needs to be well organized, written clearly and concisely, making it easy for busy decision makers to grasp the key points quickly. The quality of this documentation directly reflects the analyst's analytical capabilities and, very importantly, their written communication skills, talents often preferred in banking roles. For instance, after analyzing Omaha Manufacturing Inc., a summary section within the memo, or perhaps a slide in an internal presentation, might highlight key points. It would concisely list the main strengths identified, such as the strong DSCR we calculated. It would also transparently note the key risks or weaknesses, like the leverage level or industry factors. And finally, it would state the clear recommendation derived from the overall assessment. Preparing clear, well-supported documentation, like the credit memo, is a fundamental skill in commercial banking. It transforms detailed analysis into actionable insights that drive informed decision-making. This concludes our core content modules. In the final video, I'll briefly summarize and connect this all back to the internship opportunity. Thank you. Welcome to Module 7, where I'll give a conclusion and connect it to the internship opportunity. Over the previous modules, we've walked through the foundational analytical process, starting with an introduction to commercial banking, then deconstructing the core financial statements, understanding how to calculate and interpret key financial ratios, grasping the essential 5 C's risk assessment framework, appreciating the importance of industry and market context, and finally, seeing how these findings are conceptually presented in documents like a credit memo. Thank you very much for taking the time to review this video series, which I created to demonstrate my skills and genuine interest. I would welcome the opportunity to discuss my qualifications and enthusiasm for this role more in detail in a potential interview. Thank you, and I seriously appreciate it.